Welcome back, focused learners, to another explainer. So, today we're zeroing in on a really fascinating snapshot of the market. It's June 19th, 2026. The US markets are actually closed for the Juneteenth holiday, which, honestly, gives us the perfect quiet moment to just step back and decode the massive moves we saw in the latest regular trading session. We're going to break down exactly where the money is flowing, why it's moving the way it is, and what it's telling us about the broader economy right now.
Let's jump right in and drop our main narrative hook for today. There's this quote from the latest Kingfinity Portfolio update that I absolutely love. It says, "This portfolio is not weak, it is rotating." And I think this framing is an absolute game changer for how we look at a turbulent trading day. You see, capital isn't just packing its bags and fleeing the market in a total panic. No, it's strategically moving across the chessboard. It's an active, deliberate reallocation. And as we'll see, the market is out there choosing its winners and losers with literal, surgical precision.
Which brings us to our first major theme of the day, the market rotation and how capital is shifting.
Now, earlier in the week, everybody was totally gripped by rate anxiety, right? But then, we ultimately saw the S&P 500 push up over 1%. But here's the thing. Underneath those headline numbers, a massive tectonic shift was happening. You've got this sharp, almost violent dividing line right now. On one side, there's this absolute golden surge of AI infrastructure momentum. Think titans like Qualcomm and Texas Instruments. But on the flip side, you have the bruises, rate-sensitive assets and real estate investment trusts or REITs like Crown Castle and VCI Properties, and they're just buckling under macro uncertainty. It's honestly like watching two completely different markets operating at the exact same time.
Just to make sure we're all on the exact same page, what actually is a market rotation? Essentially, it's a strategic shift of investment capital. Money moves from one sector to another based on changing macroeconomic conditions and rate expectations. You know, investors aren't just cashing out to stuff their money under a mattress. They're taking their chips off the table in areas they think are going to get hammered by high rates, and they are sliding those exact same chips into sectors where growth just seems, well, unstoppable. So let's track exactly where those chips are going. Section 2, the crown jewels and the semiconductor surge.
Okay, the broader S&P 500 had a really solid day, up just over 1%. A good day, sure, but man, that totally pales in comparison to these semiconductor titans. Qualcomm rocketed up 6.2%, and Texas Instruments absolutely exploded by 6.9%. These AI-linked chips didn't just beat the market, they left it in the dust. They turned what was a strong market signal into a full-blown growth and quality rally.
But we have to ask, what is driving this massive premium? Well, it really comes down to one absolutely crucial catalyst. Investors are aggressively paying up for AI infrastructure optionality. The market is finally waking up to the fact that this AI revolution, it requires an unimaginable amount of computing power, and because of that, massive electrical intensity in data centers. Look, if you're a company providing the chips or the power architecture for these data centers, the market is essentially handing you the crown right now.
What's truly fascinating is when you break down the specific catalysts for these two leaders. Take Texas Instruments. Bank of America just bumped their price target up to $370, and they specifically cited demand for 800-volt data center architecture. So they've got this really constructive momentum, though the commentary signal does note they're getting a bit extended right now. Then you have Qualcomm. Their growth is heavily tied to data center AI chips and a ton of anticipation for their upcoming investor day. But check out that commentary signal, buy/hold, but with high event risk. Keep that in the back of your mind, because we are definitely going to come back to why that specific event risk matters.
All right, from the highest highs, we got to transition to the pressure points. Section 3, pressure on yield and rate-sensitive REITs.
Negative 4.3%. Wow. That is a bruising number. That's the sharp decline we saw from Crown Castle. And what's really concerning here, this isn't just one isolated bad day at the office. This marks their fourth straight decline, and it's happening on really heavy trading volume. So what exactly is dragging Crown Castle down to a risk/hold signal? It's a nasty combination of heavy headwinds. First, investors are just deeply concerned about their telecom infrastructure restructuring. Plus, there are significant execution risks following their recent fiber sale. Basically, the market has crossed its arms and is demanding actual hard proof. They want to see that Crown Castle's tower-focused reset and their debt reduction plan will actually translate into a durable recovery for their core cash flow. And honestly, until they see that proof, the market is going to keep punishing the stock.
But it is so vital to understand that this is not just a Crown Castle problem. Look at VG Properties. They just suffered a 3.5% drop. But here's the kicker. Unlike Crown Castle, VG actually just raised their 2026 guidance. So wait, why the drop? It's all about broader sector de-risking. The broader market, the tape, is simply not rewarding yield REITs when macro and rate uncertainty are dominating the conversation. Vici's drop proves, without a doubt, that this is a macro-level rate sensitivity issue affecting the whole sector. It's not just one company failing to execute.
And this complex macroeconomic environment, it's forcing a lot of patience in other sectors too. Moving on to Section 4, Healthcare and Energy Watch, the chessboard.
In these traditional defensive areas, we are seeing some pretty notable pullbacks across the board. Pfizer dropped 2.7%, Johnson & Johnson down 2.5%, and Chevron falling 2.3%. Now on the surface you might say, well, it just looks like a bad day for defensives. But when we look a little closer, the mini narratives driving these specific pullbacks are completely different from one another. Let's break them down.
Let's start with Pfizer. This is probably the cleanest company-specific negative we're looking at today. So their CFO, Dave Denton, announces he's leaving on August 15th. They name an interim CFO, and the company explicitly reaffirms their 2026 guidance, obviously trying to calm everyone's nerves. And yet the stock still drops 2.7%. Why? Because the market inherently despises executive transition uncertainty. Even though it's not being framed as some operational crisis, Pfizer is right in the middle of rebuilding its post-COVID growth story. Investors simply do not want leadership question marks during a rebuild. It's that simple.
The narrative gets even more nuanced with our other two defensive players here. Johnson & Johnson's 2.5% pullback, that happened despite them reporting really strong Q1 fundamentals and even raising their 2026 outlook. So this isn't a broken fundamental story. This is just your classic profit-taking on a softer tape. Now contrast that with Chevron. Their drop is entirely tied to the geopolitical oil chessboard. Crude volatility is the main character here. Chevron basically lost a chunk of its conflict premium because of optimism around a US-Iran ceasefire. If those geopolitical waters calm down, Chevron loses support. But if risks in the Strait of Hormuz flare up again, you bet, energy will catch a bid right back.
So, with capital rotating this aggressively all over the place, what comes next? Let's get into Section 5, Catalysts to Watch, the look ahead.
Okay, here is your actionable watch list. These are the exact events you need to be monitoring to protect and position your own portfolio. First and absolutely foremost, that June 24th Qualcomm Investor Day. Remember we mentioned that event risk? This is the biggest catalyst on the board right now. The market wants actual proof that their AI data center ambitions can turn into durable revenue, not just a cool story. Beyond that, keep a really close eye on Fed rate expectations, because that's going to dictate if REITs like VCI and Crown Castle can finally bounce back. Watch how Pfizer handles that CFO succession heading into July earnings. Keep monitoring the oil headlines for Chevron's next big move. And finally, keep an eye on European autos like BMW. Their recent profit warning pressure and that ongoing economic weakness in China remain a major macro risk.
So the absolutely crucial point is how you actually navigate this wild environment. The Queenmaker's view closes out with this absolutely fantastic piece of strategic advice. Stay selective, stay disciplined, and let the loud tape prove itself. Right now, the crown firmly belongs to AI-linked chips, while income and healthcare are kind of just waiting in the wings for rates and overall confidence to settle down. You don't have to chase every single trend out there. You just have to stay disciplined and really understand where the capital is rotating.
Which really leaves us with the ultimate question. Will the loud tape prove itself? Will Qualcomm deliver the hard numbers to justify this massive AI rally? Or is the market walking right into a trap while completely ignoring perfectly good income assets, just waiting in the wings? The chessboard is set, the pieces are moving, and honestly, it's up to you to decide where to place your bets. Stay focused out there, and we will see you in the next explainer.